Hi, I'm Kenton, and I want to share my thoughts on deciding whether to pay down or pay off your mortgage, do a cash out refinance, or a rate and term refinance. I'll also explain how a mortgage can actually protect your downside risk of owning real estate near the end of the video. Before I begin, I want to explain that this is personal, and you'll need to make the best decision for you in your particular situation. I'm going to keep most of this video focused on the financial aspect of this choice, but realize not everyone has the same tolerance for risk, so you will need to decide what works best for you. First, we need to separate the financing from the value of your real estate, which is the asset. Your house or building and the land they are built on will go up or down based on many factors, but whether you owe nothing or have a mortgage higher than the value of the property will not affect the actual market value of the property. This is an important concept for you to keep in mind. Your financing has no impact on the market value of your real estate. For the purposes of this video, I am assuming all loans are for 30 years on residential properties and the borrower has good credit with sufficient assets to qualify for as good a loan as they currently have. For most people, a real estate mortgage is by far the least expensive money they can borrow. On top of that, your interest may be deductible on your income taxes, but you'll need to consult an accountant to make that determination if you don't already know. If you can get a loan for 4% and you can deduct the interest, then you are actually paying slightly less than 4% for the use of that money. If you try to get a loan on most other assets or just a personal loan, you will surely be paying a higher rate. Now, this obviously excludes promotional financing designed to entice you to buy something, or if you have a large investment portfolio that allows you to borrow against it at a very low rate, or some other unique situation. So, if you are borrowing money at less than 4% on your mortgage, here's the question to ask. Is there an investment that will give me a return of 4% or more? If there is an investment that gives you an expected return over 4%, then you should borrow as much money as you can at 4% and invest it in the other investment. This is basic arbitrage. You borrow money at a slightly less than 4%, and whatever your other investment makes, you grow your wealth or make a profit by the difference in those two rates multiplied by the amount of money you are investing. If you have cash to pay off your loan or contribute extra to your principal each month, should you? If you pay down or pay off your loan, you are getting a return slightly less than the 4% you borrowed at, assuming you can deduct your interest and perhaps the comfort of knowing you don't have a large debt to pay off. This seems to be more of an emotional decision for some people because financially, I find it difficult to prove how you will be financially better off in the long run with your mortgage paid off. If you are feeling like you should pay off your loan, I'd like to offer another option. If you pay extra each month toward your loan principal, you will be receiving a rate of return equal to what you are borrowing at, and the money won't be easily accessible without refinancing the property. So instead, take the extra money, put it in a low-cost total stock market index ETF like Vanguard's VTI. As of August 31st, 2020, Vanguard's total stock market index had a 10-year return of 14.95% and a return of 7.84% since its inception in 2001. Now, the 14.95 is crazy, and you're probably not going to get that again, but it's nice to see that that was achieved over the last 10 years. VTI has an expense ratio of 0.03%, which is next to nothing. If you put your extra payment in this ETF and reinvested the dividends, it is extremely likely that your balance will reach your outstanding loan balance well before you would have paid it off by paying toward the principal each month. At that time, you can choose to pay the loan off completely, or you may see that your VTI investment has grown so much faster that you'll simply keep contributing to VTI and not worry about paying off your loan, as you know you have the cash to pay it off if you ever needed to do that. Now, let's do the math. If your loan is for $200,000 at 4%, your principal and interest payments would be $954.83 per month. Let's say you were able to contribute an extra $500 per month toward the loan or an investment. If we put it toward the loan, we'd pay off the loan in 14 years and 5 months. You would have made $86,500 in extra payments and saved $75,777 in interest. That sounds great, but what if we had invested those extra payments? If you had invested the $500 per month in Vanguard's total stock market index for the 14 years and 5 months, and you got the current 10-year return of 14.95%, you would have $275,000, which is over 3.5 times better than the interest you saved. If you use the much more conservative return of only 7%, then you would have over $145,000, which is nearly twice the interest you saved. Now, let's take it one step further and say you invested the $500 for every month for the full 30 years of the loan. You'd have $2.7 million at 14.95%, or over $580,000 at 7%, versus the total mortgage interest of $143,739 that you would have paid. Even at the very conservative 7%, you're over 4 times better off investing that money. Now that is huge money. Now if you have a loan that's bigger than $200,000, those numbers get even bigger. Now, I don't believe we'll see a return of 14.95% over the next 30 years, but I also don't think it'll be as low as 7%. Either way, paying extra toward principal is clearly not the best decision if you could invest that extra money for a much higher return, which most likely will be at least 4 times better than paying off your loan early. The added benefit of an investment in an ETF is that you can pull out the money at any time. Once you pay extra principal, the only way to get that money back out is to refinance and potentially lose your rate, or get a line of credit, which is surely going to be at a higher rate than you're currently paying. Should I do a rate and term refinance? In this scenario, your payment is reduced for 2 reasons. One is that you're hopefully getting a lower rate, and the second is that you're extending your term by restarting a new 30-year loan with a lower principal balance. This means the lower principal balance is spread out over 30 years at a lower rate, which would result in a lower monthly payment. There isn't anything wrong with this, and the costs for the loan are normally a little lower when you're not taking cash out. In my opinion, this makes the most sense if the new rate is lower and you don't have a significant amount of value to cash out. Your mortgage broker can help you do a cost-benefit analysis to determine how many years it will take for the savings to equal the costs of the refinance. Should I refinance and take cash out? In today's environment of decreasing interest rates, my opinion is usually yes. First, when you take cash out in a real estate refinance, that cash is not taxed. It's tax-free money, even if it's an investment property. When you do a cash out refinance, the cash is not income and it's not capital gains because you didn't sell anything. Next, since rates have been dropping, your payment may not go up that dramatically, both because the rate is lower and you're restarting your loan for an initial 30 years or another 360 payments, even though you're increasing the principal. Regardless of the rate, if you can pull out cash and put it to work in any investment with a higher rate of return than your mortgage rate, that would be the best financial decision to grow your total net worth. This decision cannot be made without taking into account your full financial picture. If your income drops unexpectedly, you'll need to have access to cash, a line of credit, or a fairly stable and liquid investment that you can hopefully sell without taking a huge loss, which of course would negate the whole reason you took the cash out to begin with. I also acknowledge that each person really needs to use this information to make the right decision for themselves, and I would recommend talking with an accountant, a mortgage broker, and a financial planner. I want to remind you that in this video I'm essentially explaining that borrowing money at a low rate and investing it at a higher rate will make you more money in the long run. This is not advice, but more of a financial mechanism for you to grow your net wealth. One other thing that no one seems to talk about with regard to mortgages is what happens if the value of your real estate goes down dramatically and you need to sell. If you own the property without a mortgage, you take the loss. Now, if you have a mortgage, you can reduce your loss by potentially working out a short sale with the lender. A short sale is where the lender acknowledges that the value of the property is less than the amount you owe, and they agree to let you sell the property for less than the remaining balance on your loan. In this situation, the lender will relieve you of the difference without foreclosure, which reduces your loss. You will need to pay taxes on the difference, as it is debt forgiveness, but it won't be a complete loss that it would be if you didn't have a mortgage. The short sale also won't hurt you financially the same way a foreclosure or bankruptcy would. So, although this is a worst case scenario, the mortgage actually reduces your downside risk with regard to declining property values. I hope this video helps you in making your decision of whether to pay off or pay down your loan, do a rate and term refinance or a cash out refinance. If you like this video, please consider subscribing, liking the video, and leaving me a comment. Thank you for watching.